able to provide the time and investment for all of our volunteers and everybody that's making these events possible here in Los Angeles. So thank you. We wanted to first start with acknowledging our sponsors. We have our platinum sponsors. We have our gold sponsors. We can continue on. We also have our silver sponsors. And we also have our bronze sponsors. So without each and every one of you who have sponsored these events, these events would not be possible. So thank you so much for your continued support. And if you're interested in learning more about how to be a sponsor and be engaged with our chapter, you can reach out to myself or our chapter administrator, DJ. We'll be able to provide contact information at the end of the webinar. So thank you again for attending, and let's get started. So first and foremost, welcome our panelists. Thank you so much for being here with us and investing the time to share with our members. What we're going to do is we're going to have each of the members, each of the panelists, introduce themselves, give a little bit of background about their company and the type of lending they do. And from there, we will start with the panel. So first, we're going to start off with Gilda Rivera.
Thanks, Francisco. Good morning, everyone. My name is Gilda Rivera, and I'm with George Smith Partners. I thank all of you for joining us today. I don't want to bore you. I bring over 20 years of experience as a commercial real estate lender and mortgage broker. I offer expertise in structuring complex capitalizations, including senior debt, mezzanine, and joint venture equity financing for virtually every category of real estate across the United States. My firm, George Smith Partners, is one of the most prominent real estate capital advisory firms, in California, if not Western states. The total volume of capital played by George Smith Partners in the past 24 months totals $5.3 billion, and the firm has transacted on over $56 billion to date. We have a vast array of capital providers, including, but not limited to, investment banks, debt funds, family offices, REITs, credit unions, agencies, etc. Thanks, Francisco.
Thank you, Gilda, for your introduction. Really appreciate that. Next, we'll have w.wang.
Thanks, Francisco. Good morning, everyone. My name is w.wang. I'm with JPMorgan Chase. While we are a firm of over 200 years, we manage over 2.6 trillion client assets and over 100 plus global markets. We're in a fast-moving, increasing complex global economy. Our success depends on how faithfully we adhere to our core principles, delivering exceptional client service and acting with integrity and responsibility. With our business banking group, we focus primarily on owner-user commercial real estate financing, and also for long-term and short-term financing needs, as well as capital expenditures and working capitals. Anyone that has those type of needs, feel free. We're always here to help with our business and small business owners. Personally, I've been in the industry for over 12 years, and it's been a very great pleasure and an honor to be on this panel. Back to you, Francisco.
Perfect. Thank you, William, for your introduction. Next, we have Michael Kaplan.
Thanks, Francisco. Good morning, everybody. My name is Michael Kaplan. I am with Slatt Capital, which was formerly known as Barry Slatt Mortgage Company. We are a full-service mortgage banking firm, almost 50 years old, domiciled in Northern California with offices in Southern California, San Diego, with outreach across the country. Our core business is middle market, commercial and apartment finance. Our main source of lending does come from insurance companies. We originate and service on behalf of 14 different life insurance companies that have programs that offer financing from $1 million up to $100 million across all asset classes. Certainly, life insurance companies by nature are more conservative. But in addition to those relationships, as a full service shop, we do have long-standing relationships with Wall Street, with commercial banks, credit unions, as well as debt funds. I've been with Slatt Capital since 1997. I started as an analyst, was an originator, was the chief operating officer, and now current president of the company. And look forward to the panel today. Thanks, Francisco.
Great, thank you, Michael. And next, I'll introduce myself fairly briefly. My name is Francisco. For those of you who know me or those who don't know me, my name is Francisco Williams. I'm actually with Williams Capital Group. We are a mortgage debt fund. It's part of our family ecosystem of the Williams family of companies. And I'm here as your president for CCIM Greater Los Angeles chapter. So I am actually your president for 2020 and 2021. So for those of you who are involved with our who want to be involved with our chapter, who are looking to learn more about CCIM, please feel free to reach out to me. Again, I'm going to be saying that throughout the panel, but again, I am the 2020 and 2021 chapter president. So let us begin. So with our panel today, and considering the COVID-19 impacts on commercial real estate financing, one of the key questions out there are you lending right now? And could you guys kind of start with that simple question, and we can go from there.
Gilda, you want to go?
Michael,
yeah,
you want to start? Gilda?
Okay, it doesn't matter. Yes, absolutely. We are lending. Every day we have more capital providers re-enter the market, including the return of CMBS. Many lenders are becoming more creative in securing new business. Borrowers are reaping the benefits with better pricing, longer term options, and new opportunities for lenders. So meaning we're lending, we're very active, and there's an uptick in the lending activity.
Yeah, I would agree with Gilda. We're seeing actually very similar activity year over year from 19 to 2020. Yes, we're in a completely different environment than we were at this time, last year. But at Slatt Capital, in the middle market space, working with life insurance companies, banks, credit unions, there is a tremendous amount of liquidity in the marketplace. Yes, lenders are more conservative. They are looking for very specific assets to lend on. They are avoiding certain assets to an extent. I think we all understand what's going on as a result of COVID and where some of the weaknesses are in the commercial real estate space. But that's not to say that there is a complete, black box, so to speak, around retail, as an example. So liquidity remains high. Lenders, as Gilda stated, are returning back into the marketplace. In the life insurance company space, for the most part, they didn't leave. They adjusted product type as a conservative loan approach. They tend to do extremely well in volatile markets. They tend to get opportunities they would not otherwise get in a very volatile, very fast-paced market without many hiccups. So, the last 90, 120 days that we've, been focusing on the impact of COVID, a number of our insurance companies have really stepped up and I think have been rewarded with great assets and great sponsors. But I see that continuing as we head towards the end of the year. I still think liquidity is going to remain strong. And to Gilda's point, I am also seeing a number of lenders that did take a step back, come back into the market.
Yeah,
William.
Thanks. So to piggyback on Michael and Gilda's points, Chase is definitely lending. We're going really strong. and continue to just help our small business and business owners, whether they are transitioning their business to capture the demand change, based on like how they're working with their clients, and just in the owner-occupied real estate space, we're continuing to see a huge demand, and every type, the fact that the current rate market is extremely beneficial and extremely attractive. We're definitely continuing to help our business owners and businesses to continue with their continuity as well as growth. Of course, we're just kind of transitioning some of our the questions that we may ask. How are the businesses transition out of or staying afloat in this pandemic situation? But we're just to what Michael said, there's a lot of liquidity in the market, and we're just trying to fulfill and also to match up with the demand when our clients need those. So JP Morgan Chase has always been a strong supporter of that. So yes, we are lending.
Great. And you guys really share a lot about, the fact that lenders are still engaged in the marketplace and that lending is happening. So if you guys could kind of add a little more color to that, to sharing what is actually getting done and, the types of deals that are getting done.
Mostly multifamily and industrial, some self-storage and land for development. All lender types strive to compete for industrial deals and look for them to provide cheaper pricing in order to win business. Industrial is expected to come out of the pandemic stronger, as it has accelerated the shift away from brick and mortar retail and toward e-commerce, which is independent on industrial space. While capital will be available in the retail sector, lenders will be extremely cautious. The pandemic has forced many lenders to leave this space altogether. And those that remain will be more conservative with higher pricing and leverage. Some lenders will want to wait at least another 3 to 6 months before re-entering the sector. On multifamily, both CMBS and agency are very competitive depending upon the borrower's business plan and purpose. They both can offer full-term interest only with pricing as low as 2.5%, and that's non-recourse, with 6 to 12 months principal and interest reserve for CMBS and Fannie and Freddie, respectively. So those are the deals that we're getting done lately.
Yeah, I mean, our platform is not too different than Gilda with respect to the focus shifting away from hospitality, away from retail. As I said before, there are retail deals getting done. Hospitality is not quite started that resurgence yet. We are seeing little grass shoots there, but I think that's going to be a fair amount of time before that comes back with any real focus. As a firm, if you look at our history, we've historically played in the retail space. I would say at anywhere from 45 to 50% of our annual origination. Part of that is a function of representing some of the most consistent life insurance company lenders in the retail space. We represent Standard Insurance out of Portland and Symetra Financial out of Seattle. They historically have been a middle market retail lender, a very good one for that. They have shifted a little bit, therefore our approach shifts too. And so, that 45 to 50% is probably down to about 32%. if you look at 2019 and 2020 retail origination. What is getting done in the retail space is grocery anchored shopping centers, or anchored retail by essential retailers. So, a Home Depot, a Lowe's, a Costco, a Target. You are seeing generally in the grocery anchored space, it's the top 1 or 2 national tenants, depending on what market you're in. If you're back east, it's a Wegmans. If you're out here, it's a Whole Foods. If you're in the South, it's a Publix. So, again, really top 1 to 2 grocers in the market as your anchor. Those deals are getting done in that space. Single tenant, drugstores, dialysis, automotive focused, Advanced Auto, O'Reilly's. You're seeing a massive influx of medical into the single tenant world that's getting done. A lot of lenders classify that as retail. Generally, they used to have urgent cares and other medical, micro hospital uses. Generally, they would be on hospital campuses or, medical office campuses. Those have all shifted into retail spaces for the most part. Developers were able to get those at the land cost was a little bit cheaper. They could build out a freestanding building, which doctors preferred being in. So we're seeing a big transition and influx of money into those specific areas in retail. So as I said, retail can get done. Gilda touched on multifamily. It's, the hottest product, whether it's life company agency or Wall Street CMBS, there's tremendous capital available. And then, office is a little bit muted. We are seeing office deals get done. It's tending to fall in that kind of 2 to 4 story garden style, non-downtown, product. We all know the shift of working at home. We all know the shift of working in more open space. No one wants to get in an elevator. It's resulting in a shift in how lenders are looking at office. So, it'll be interesting to see how quickly that comes back. Storage is a hot product. Again, it's a product that's held up through COVID. Again, you've got to think of storage as a business. So, people, lenders are going to look at that, and it's not just, a shift to, a specific class that is, we have great tenants. It's do we have great operators? Do we have, well-located real estate? Not all storage is getting done. Well-located storage is getting done. Having very strong operators, those deals are in high demand. And then, obviously I touched on hospitality being kind of last in line.
All right. Thank you.
Yeah, so,
And I'll
piggyback, I think, so in Chase business banking space, we're focused on owner user, and just, with this type of changes in economics forecast and the impact of the pandemic, we're looking a lot towards basically non-cyclical businesses. And I think historically, Chase has always been more lenient towards, just non-cyclical, or, how the business are cyclical towards, economic changes and such. So in an environment like this, we're continuing to stick to that. As a cash flow lender, we're still just based off of EBITDA, a lot of those ratios, book cap, total debt, and just looking at just borrowers holistic, their leverage, right? If, we're looking at, LTVs at 80%, pre-pandemic, we might be just kind of shifting gears, being a little bit more conservative, I think, reacting to the pandemic and shaving back maybe to 70% LTV. And it really depends on like some of the type of collaterals that we're looking at. If it's a real estate deal, we're looking at just how the real estate being used, and we're focused on industrial and manufacturing, you know, and in this time, I think we are just leveraging a lot of the partnership with Small Business Administration, because the programs that they have specifically about the 504 and the 7A, you know, we tend to just mitigate some of our risk and mitigate some of our just collateral coverage, right? And helping our borrowers at the end of the day and trying to just minimize their equity injection. But I would say, like, getting deals done and closing those deals, always prepare to have like liquidity available, right? You know, when pre-pandemic, we were seeing a lot of those SBA 504s, 90% LTV. But you know, in this pandemic, when, especially in this rate environment, when those opportunity arises, you know, just it's great. It'll be great to have more liquidity available so that it, you know, when we're looking at maybe 15% down payment instead of 10% down payment, things of that nature. And bottom line is just, you know, the industry type, how volatile and cyclical they are to the economic changes, I would say. You know, while we like to finance a warehouse, you know, for manufacturing and industrial purposes all day, right? It really depends on the borrower, and, you know, owner-occupied space, we got to look at the operating company, how they are reacting to these type of economic changes and how they're transitioning, right? So those are some of those, you know, I would say, like, intangibles, I guess, that we just gotta to either educate the borrower or, you know, seeing how they're transitioning and changing with their competitors and such.
Yeah, I think just to add one note, and William mentioned, you know, liquidity and you know, really drilling down on the intrinsics, you know, whether it's net lease investment or it's a multi-tenant deal, regardless of, you know, it being an office, an industrial, or retail. Lenders are very much focused on the underlying source of repayment now more than ever. You know, well, we're in COVID. I mean, a lot of people refer to it as post-COVID. We're right in the middle of it, and you know, we're still seeing the impact of tenants, and these are across all lines. It's not just your mom and pop tenant that's struggling. Your institutional tenants, your credit investment grade credit tenants, you know, they're making do, but they're not paying rent. You know, I mean, so it's broad spread. So lenders have shifted their focus, you know, to the secondary source of repayment, whether the loan is recourse or non-recourse. They're still looking at who's behind, you know, the deal. And so areas pre-COVID that were pretty, you know, robust, such as cash out refinance, or you know, clients with not a lot of liquidity. They may be equity rich and cash poor. You know, those deals getting done pre-COVID were pretty regular. You know, where we sit today, yes, there are cash out deals being done, but it's muted. You know, there's either principal and interest reserves, or there's, you know, maybe there's a guarantee on the portion of cash out that is there. It's not as available as it was pre-COVID. So I think, you know, liquidity is a huge thing, regardless of asset class. And I think, you know, cash out, or you know, those other kind of every last dollar borrower, they have been impacted. They're not seeing the availability of the source of the type of money that they saw pre-COVID. It is there for the right projects, but as a you know, majority of what's happening, it's all been pulled back to an extent. And one other note on just you know, this isn't necessarily about what's getting done, but it's how it's getting done. Low leverage today in this marketplace is being rewarded like we've never seen it before. People who don't necessarily need to borrow are borrowing in today's market because they've not seen rates this low. We are at historic low rates across all lenders. You know, the banks and credit unions, they have a cost of capital they're not going to dip below for the most part, but CMBS and life insurance companies are providing low leverage financing at numbers we've never seen before. You know, Gilda mentioned it early, you know, 2.5% in some cases. You know, 10-year money at 2.5% is a gift, and leverage drives that. So if you can stay 50, 55, 50% leverage or less, you're going to be rewarded. It's available.
Wow. And that's the market that we're in, ladies and gentlemen. And there's something I'd like to share with everybody. We had a conversation, and we actually had a presentation from the CCIM Institute from our chief economist, Casey Conaway. And it's actually a snippet of the presentation. If you haven't seen it yet, I highly recommend. I'll be able to have our chapter admin post, get in touch with our chapter admin, and we'll be able to get you a copy of that presentation and the specific webinar. But what I wanted to show here is that I wanted to show everybody that on the panel, and also we had a conversation about this. You know, there was a conversation here. What you see here are numbers from TREP, CMBS Research. For those of you who don't know, TREP, it's a software platform that tracks CMBS data, loan data across the nation. And what they shared overall is that they have the following numbers here. As of May 2020, overall CMBS special servicing rate, loans that are being sent to special servicing. And then we also have the delinquency rate per product type on the chart on the right. So as we're starting to see here on the far right in June, industrial has the lowest. You have lodging, multifamily, office, and retail. And then from there, you go to the left, you're seeing industrial and all these other product types that are actually going to special servicing. And there was a comment saying CMBS is the canary in the coal mine, the CRE indicator. Well, you know, what do you guys think in regards to these statements and these numbers?
Gilda, do you want to go, or I can go?
No, you can. You can, Michael.
I mean, we have dialogue on this point, you know, routinely. You know, we service about $1 billion of our $4 billion in loans is made up of CMBS. As of yesterday, we don't have a single late pay or delinquency in our, you know, $1 billion of CMBS. I keep reading articles about it being a canary in a coal mine, and there's probably some, you know, legitimacy to that. That being said, you know, I think that's coming off of the heels of looking back to 2008, 2009 and the Great Recession, and how fast the CMBS market, you know, dissolved itself, and how quickly, you know, special servicers, you know, were taking properties over, and how quickly those deals were foreclosed out. It was, you know, for lack of a better word, it was a bloodbath. I don't see that today. We're not seeing it get to that point. Yes, there are malls and there are big retail centers and there are hospitality portfolios that are, you know, leading this delinquency. But it is not a, you know, it's not more than 25% of the entire CMBS market. You know, the other 75% of CMBS is performing extremely well. Multifamily, industrial, office, most of the retail other than malls and CMBS are performing. And so, you know, the other component to that is, compared back to the Great Recession, is how quickly those projects, you know, moved from the current owner to special servicer to actually being sold, you know, out of foreclosure. We're not seeing it move that quickly today. We're seeing a lot of people trade paper, but it's institutions that have a ton of liquidity trading paper with each other. It's almost lateral movement, you know, coming out of CMBS, moving into, you know, private equities buying that paper. They're coming in, they're recapitalizing these owners. We didn't have that sort of liquidity in 2008 and 9 that we have today that's allowing this to right itself without a complete, dumpster fire. One of the questions I saw on the chat was, are we seeing an increase in CLO versus CMBS? I'm not seeing CLO come back. That's another securitization product. Generally, it's cooling up of bridge loans and a number of not necessarily long-term fixed rate assets like CMBS. We're not seeing a lot of lenders dive back into that because they're not able to secure their lines of credit from the big banks. It's a slow process for that coming back. I do expect it will come back because it's a very profitable business when it is flowing. But we're seeing a lot of lenders that were in the CLO space still lend, but they're not doing it on a leveraged basis. And so you're seeing them, increase their pricing. They're performing in a space that I call rescue capital. So it's, they're the ones that are kind of buoying, these lodging assets and retail assets that you see in this report by TREP. They're coming in and providing that recapitalization money. It's not cheap money. It's 11, 12, 13% capital. But it's cheaper than equity, and it's better than having your property go away.
Very true. Does anyone else want to tackle that? Have any comments? No, I can take it down.
Michael is the expert. He covered everything already.
There we go. Perfect. Oh, my apologies. I think I had a message here. Show the larger screen. My sincerest apologies. If everyone had not seen it, I will make sure that we send out that page. Okay, I'll make sure that we send that out to everybody that participated so that everybody has that slide. So we'll make sure we get that out to you. So, next in our conversation here, as we look at the different, we actually have some questions that just popped in from our audience. Someone had heard from a banker that about 25% of all CMBS loans are in default. Is that correct? I'm not sure if I have that information in front of me, but I think there is a certain percentage of. Again, I don't have that information in front of me.
Yeah, I mean, I'd be surprised if that's a if that percent is accurate. Like I said, there are certainly a very large number of hospitality and retail, specifically in the mall space, assets that are in default or have been moved to special servicing. You also have to understand that there are non-monetary defaults in CMBS that are probably included in that number. That could be a property may be performing, they may be making their mortgage payment, but the anchor tenant could be dark, and there could be a cash flow sweep in place, and then that transaction as a result of that is labeled on a watch list. Could be moved to a special servicer. We've seen that, Slatt Capital as a servicer for CMBS, we generally are a sub-servicer. And in the event where a trigger event happens, such as tenant going dark or cash flow sweep trigger clamps down, we do shift that loan to the special servicer or mark it as a watch list loan. So there is, in many cases, there's nothing wrong with that transaction. The borrower is still making their payments. It's technically not in a monetary default, but it has been moved to a certain category that could be classified that way. But I still think 25% of outstanding CMBS being delinquent is too high a percent.
Great, thank you. A little shift for Gilda, actually. Right now, I understand you're in the space of ground up construction. Could you share a little bit about that type of lending and which product types are actually getting financed right now?
I can start with that, Francisco. I think that the reception is kind of I barely hear me,
We can hear
Francisco.
you now.
Hello,
We can hear you now.
Francisco.
Yeah.
Okay, because I barely heard Michael. So one more time, I barely. Francisco, repeat the question because the reception is not that great.
Yes. So yes, definitely. So we were talking about ground up construction. So that type of financing, we understand you know, George Smith Partners, you guys do a lot of that type of financing. So if you could share a little bit about what product types are being financed and what you guys are looking for in the ground up construction space.
Sure. Count on banks and life companies, big and small, to put most of their focus on existing clients and for the right multifamily and industrial assets. Loan to cost ranges from 75% to 80% for multifamily money nationwide, up to 90% in some cases. Real. Investment grade, single and multi-tenant. Obviously, if you have an Amazon tenant, that's something, you know, any developer or investor can get up to 100% financing. Lenders cherry pick retail deals again, and they're extremely cautious. That funds private money and opportunity funds with a higher cost of capital will fill the void left by the major banks. Rates will be in the 3% and up to 10% range. So that's your private money or private equity type of financing. Expect demand for HUD or HUD loans under the category of agency to increase because of the attractive terms and built-in permanent financing. Because there's a surge in multifamily construction lending throughout the third and fourth quarter. What else? Multifamily projects in the best locations with strong sponsors will see available capital, although with more conservative occupancy and rent growth underwriting. Projects are taking longer to get through the entitlement and planning process. And there are concerns about the availability of workers on job sites. What else can I share about construction? There is a high degree of focus on what future market rents and vacancies will be over the coming months. And borrowers are having to come with, you know, additional equity or down payment to make lenders comfortable, just like what Michael stated earlier. Lenders will take a closer look at the last 3 months of occupancy and rent collections. So that's where lenders, you know, in the construction space, looking at and underwriting projects recently during the pandemic.
Great. Michael, do you want to add anything to that, or?
Yeah, I mean, I think Gilda, you know, Gilda and her group, you know, certainly do a lot of construction, and they are experts in that space. So I mean, she covered that pretty well. The only thing that I would add to that is, you know, as you shift away from multifamily, which is, you know, the preference, it's where the majority of construction money is going. You know, next in line, obviously, is build to suit industrial. I'm sure, William, you can add to that too. But you know, build to suit industrial. There are construction loans available for pre-leased retail. One sector in particular that has gained a ton of traction in the last 24 months is the, you know, 90 to 100% financing of single tenant properties, you know, where you have a build a suit for a 7-Eleven or a build a suit for a Wawa, C-store gas, or a build a suit for a FedEx ground. Capital is very much available in that space at high loan to cost. So it really does fit your merchant builder. Little difficult if you're a builder that wants to hold the asset, because you borrow at 90-100% of cost, and then you turn around and try and put a perm loan in place after construction. You're bringing in capital to make the loan to value work for your long-term fixed rate lenders. So most of those deals are being built and sold in the secondary, not secondary market, but in the for sale market, usually to 1031 exchange buyers. We are, we've seen a pullback a little bit in storage construction. I think there's just a little bit of a, refocus of, what that market and what that arena looks like going forward. So, construction funds are available. It's really primary, strong secondary markets. The tertiary market, storage properties that had a lot of, activity, lenders have pulled back a little bit in that space. And then obviously, there's almost no construction going on in hospitality. There's conversion, a lot of hospitality being converted into, back into apartments or back into office. So the bridge construction space is extremely active. And Gilda touched on those lenders. It's the same pool of resources.
Right.
So Chase is definitely we're always focused on the owner user space. So that being said, if it's owner user, let's break down into like two different type of, I would say, like ground constructions that I mostly experience. So industrial, right? Just to crack at the current environment, if we have a PPE wholesaler selling coveralls or items and that such, right? And they wanted to have a ground construction or a major like tenant improvement to fit their operation. We're certainly open to that conversation. Has there been like changes to our review? Yes, I would certainly say so. I think it's just about the readiness of like how going into escrow, or just looking at like how the plans are fit out, and having like a contractor to to be as detailed as possible, I would say. I mean, the way that we structure ground construction is, again, partnering with Small Business Administration, and we're still looking at like 90% loan to value or loan to construction cost. Another scenario, since we're talking about retail, right? Favorite type of retail, we're looking at just healthcare providers. The most that I've experienced probably are dentists and some specialty surgeons, outpatient, and that sort. We're still entertaining that, right? We're still entertaining those type of ground constructions, and a lot of times we'll finance those equipment like at a long-term amortization as well. Like we're talking about 20, 25 years and such. So I would say it's just for our segment and risk appetite of owner occupied, just having that detailed understanding of the operating company and how they're coexisting and transitioning through the pandemic, right? And changing their business. And as cash flow lender, we're just looking at like how this business is operating. I think so. Most of the time, we're talking about owner occupied space, looking at 51% or more occupancy of the property. In current environment, and especially for ground construction, definitely want to expect, and we're going to educate our borrowers to occupy. They'll have to occupy a lot more than 51%. It is case by case. We're looking at 70, 80, 85% occupancy for ground up constructions when it completes. So
great. We have a couple questions in the chat and in our Q&A. Gilda, if you want to take on one of those questions, I think we were talking about construction.
Sure, but I
It
didn't
says right
read
here-
the question. What was the question?
Oh yeah. The question is there a difference on loan to cost at certain loan limits for ground up construction?
Can she or he expand the question? Is she referring to loan to cost, like maximum loan to construction cost on any given project?
Yeah, correct. That's what he's asking. Mm-hmm.
Okay, so it's case by case. What I mean by that is if it's multifamily, it's a favorite asset type or class. If it's HUD, you can definitely, obtain up to 90% of the total, 90% loan to cost. But HUD, it takes a while, meaning it takes 18 months to 24 months to close the transaction. If that's multifamily. For industrial, yes, like I said before, investment grade, it's also, there's a huge appetite for that. In some cases, we can go up to 100% of total project cost or 100% loan to cost. Mm-hmm. And for other than that, or other asset types or classes, up to 75% loan to cost. And there's just too many variables to consider. They have to look at the market location, the sponsorship, the track record, the liquidity, and whatnot. So the moon and the stars must be aligned to get the kind of financing in the construction arena.
Right.
I mean, I think the only thing I'd add there, and I think, I guess I'm reading the question a little different as well. The ask is, is there a threshold, at a certain loan size that those metrics change? Yeah. And I mean, I'll give my 2 cents, but I think Gilda, you've got a good perspective on it because you guys do much larger construction loans than most mm-hmm. brokers in the marketplace. But yeah, size matters. It absolutely matters. If you're looking for high leverage, a senior plus mezz on a $10 million loan, you're very much going to be challenged to find that. You're going to be, traditionally 65, maybe 70%, if you're lucky, up to 80%, with a bank and maybe a small mezzanine loan. But if you're in that 30, 40, $50 million cost or greater space, you bring in a lot more players into that world. You bring in private equity firms, you bring in debt funds, you bring in sovereign wealth funds, you bring in family office money, that can really help leverage those projects up. And you just have to make sense of the cost. We've seen a contraction or a compression in the cost of mezz and the preferred equity and all the junior lien positions. It has gotten cheaper, but you still have to make sense of the layered in capital.
Right. For everybody, we are getting a little tight on time. We're scheduled to end at 12, but with permission of our panelists, if you guys want to stay on to answer a few more questions, we do have probably a handful of questions left. Just if you guys can stick on for a little bit longer, we'll power through these.
Sure.
Okay. Mm-hmm. Perfect. So we have a couple of the same questions. For deals in your pipeline that you're underwriting now, where are appraisals coming in at recently compared to pre-COVID? And is this an issue with fewer sold comps from which to draw and study?
I can start with that. This is an experience based from my recent deal that I worked on. It was for a 28,000 square feet single tenant retail property in South LA. we were expecting a $12 million value, and the appraiser came back with 10% reduction because the rationality or the justification of that is they have to now use a cap rate stress test. So by average, the appraisers has increased about 50 basis points on the cap rate alone. So that's just based on my own experience recently, and it has impacted a lot of our deals.
Yeah, we're seeing that as well. I mean, unfortunately, it's still it's an art, not a science. I mean, in some aspects of appraisal, there is some science, but it's still someone interpreting data and giving a forward-looking forecast of value or what they perceive value to be. So, you know, we're not seeing it on every deal. I would agree. We're probably seeing a 8 to 12% adjustment in many of the appraisals that we're seeing. To be honest, we're doing more of the appraiser's work than we ever have. We are providing comps. We are reaching out to brokers and getting that data. The biggest challenge that appraisers have right now is they can't go and do inspections. They can't go and sit and interview people. They are a little bit handicapped with respect to how they normally do business. And you're seeing some progress being made in the large appraiser companies, you know, the big corporate, large format appraisal firms. I'm not seeing the range of you know, I guess challenged values that I am seeing more in the individual independent appraiser world. So hopefully they're getting back to kind of a more normalized approach to things, but it is having an impact. But you know, it is case by case.
I think
Great.
from what
Great.
I've
Thank
experienced
you.
so far, fortunately, I haven't seen like much difference in valuation, but more so on the time aspect. Just like Michael said, a lot of the restrictions what the appraisers are experiencing. So, but again, you know, we're working in an owner-occupied space, and if just, I think just having an expectation of that, our environmentals are taking a much longer time. Right, historically, I think pre-COVID, we're looking at like 45-day finance contingency and 60-day escrows. Right now, things are getting delays. I think the few deals that I've experienced so far, like during the pandemic, you know, it's just taking much longer, where appraisals come back in like 3 to 4 weeks, and we might see some further delays on that, where it's taking a month and a half sometimes because of, you know, various restrictions and reasons.
Perfect. Thank you everybody for sharing your insight. There was a follow-up question about new ground-up construction. So it's also affecting ground-up construction as well, correct?
Correct.
The evaluation, right? So perfect. We do have a couple other ones that were sent in advance that I wanted to get to. And I'm going to probably just ask the first one. I think somebody from Michael's office sent this actually. I would like to hear your feedback on retail, assuming 60% loan to value. What is the market like for multi-tenant with high quality tenants, multi-tenant with mostly independent tenants, but they are paying rent, A to B quality single tenant with 10 plus years of lease term, and a grocery anchored neighborhood retail anchored as well. I know it's a lot, but this is what he cares about most. So if you guys can share some insight about that type of retail.
We do a fair amount in this space, and right now, look, things are different. And I'll lead the answer by leverage matters. You know, if you're pushing the envelope on loan to value, and in many cases 60% is pushing the envelope. California retail, we've not seen the correction in prices. We've not necessarily seen the correction in cap rate. So a 60% LTV is a full loan, frankly. you know, especially if you're at a 5 cap or between 5 and 6% cap rates, grocery anchored, for sure, you're going to be a full loan. So leverage matters. The other thing that matters significantly is recourse. So, you know, if you have strong sponsorship, liquid sponsorship experience, someone that can manage the challenges that the mom and pop tenants and even frankly the big tenants are presenting in retail, they can carry the loan while giving support to those tenants. Being able to show that is a major factor today. So lenders are looking. They don't mind that you've had forbearance agreements. They don't mind that you've restructured leases, but they want to understand what it looked like. You know, what did you do? How were you able to keep the tenants in place? So all those factors come into play. We've closed over the last 120 days. We've closed, you know, 30 retail strip centers, you know, from $1 million to $10 million. They've all had different stories. They've all been impacted. And so, you know, and they've all ranged from 50% leverage to 65% leverage, and receiving competitive financing. But you got to tell the story. You have to be prepared as an owner. You have to, you know, the lenders are asking far more questions than they ever had. But there is available debt for that product. And as I said earlier, quality does matter as well. You know, if you're grocery anchored, top 1 or 2 in the sector, you're going to get a lot more interest. If you are a strip retail center, you know, kind of mid block, you know, with a restaurant, a nail salon, a hair salon, and a, you know, and a laundry, you're gonna have a little more of a challenge, you know, getting that deal done unless you're lower leverage or have some strength behind the deal. But you know, that's just kind of where we are right now. I'll give you an example of a loan that I just went under application on, and this is where geography and leverage matters. So the asset is in Northern California. It's in a, you know, high net worth, you know, high demographic area. It is a 28,000 square foot retail shopping center with no credit. So all mom and pop tenants. Almost every tenant had some type of forbearance given or some type of concession provided. But the loan to value on this property is 40%. And it's a $4 million loan, 40% loan to value. And one of our insurance companies is very interested in it because they look at the intrinsic land value, and that land value is almost $8 million. So they look at that and they say, well, you know, no, we don't like the tenant makeup, and we don't like that there's been, you know, holes in rent payment. But yeah, we're really well insulated with value. And that application is signed up on a 10-year fixed rate loan at 3.5% fixed rate and a 25-year amortization, and it's non-recourse. So, you know, again, that deal at 60% leverage doesn't get financed non-recourse. So that's where leverage matters, and the nuance of understanding, you know, the intrinsics played a huge role. If that at 60% leverage, you know, because we ran that process, it was recourse financing, it was bank financing, and the interest rate was 3.85 to 4%.
Got it. Perfect. If anybody has anything else to add, at that, I think we're gonna end the panel, ladies and gentlemen. Thank you so much for sticking on with us for an extra 5 minutes. Thank you to all of our audience and our attendees. Thank you to our sponsors. For everybody who attended today, thank you for your questions. And again, thank you for joining us. We're really excited about our chapter and about all the different events that we're going to be having upcoming. DJ, if you want to click to the next one, we have our next webinar coming up September 10th at 11 a.m. And we're going to be talking about the most updated impact on commercial evictions and landlord-tenant relations. Right now, as you well know, in September, they're going to be ending the moratorium on evictions, and they're going to start hearing cases. So there's some changes happening here in California, and we have our next panel to go over. So please stay tuned. If you're a member, thank you for continuing your membership. If you're not, become a member of CCIM Greater Los Angeles. This is the type of conversations, this is the network, and not only that, this is a community that you get to be a part of. So we encourage you to sign up today. For all of our members, you guys are going to get copies of this presentation and our link to the recorded webinars. So again, thank you everybody who's part of our membership, and for those who are not members, please consider joining. And if you have any questions, reach out to myself or DJ. And again, thank you to our panelists, Michael, Gilda, and William. Thank you so much for your time.
Thank
Hope
you.
you guys have a great
Thanks,
rest of your day.
Francisco.
And everybody have a great rest of your weekend too. Take care.
You too. Take care. Bye-bye.
Thank you.
Bye.